So what's the big problem with wealth creation? How do people like us, who didn't inherit a boatload of money, who are investing and building wealth from our own blood, sweat and tears, how do we invest in a way that gives us remarkable results and become financially free before retirement age? I don't know about you, but I am sick of hearing from wealth gurus and experts who don't walk their own talk and prescribe strategies that are a one-size-fits-all approach. For self-made people like you and me, I'm here to tell you that you don't need to be superhuman or already wealthy to reach financial freedom earlier than 65. This is the Alternative Investing Podcast. Hey, Salena Kulkarni here again with another episode of the Alternative Investing Podcast. Today, I want to talk about risk and reward. There are an army of wealth professionals out there who are taught that risk and reward are like a married couple. They go together. And if I had $1 for every person who told me that higher returns automatically imply higher risk, I'd be rich from that alone. So in today's episode, what I actually want to unpack is this myth and how to navigate that kind of flawed thinking if you are an investor who is looking for an edge and who is actually interested in earning better than poultry returns. Let's start at the beginning. I think investing for most people has become this very commoditized thing, meaning that wealth planners, they want us to put our faith in them and their products. This is what they're trained for. This is what they understand. This is how they get paid. Now, anything that sits outside of their field of knowledge must be dangerous, must be risky, and should be avoided at all costs. Now, obviously, my asterisk here is I have a lot of friends in this space, and some of the people who I'm talking about, they're good guys and girls, but it's just that whole thing of you just don't know what you don't know. And the truth of the matter is that because of the limited access to deals outside of the norm and the lack of wisdom, we assume that risk and reward must be related. In fact, I would hazard a guess if we were to interview or put, the whole population through a questionnaire of some sort, they would probably go, yeah, risk and reward, it's correlated, because that's over the last 4 decades what we've been taught to think. I want to actually unpack for you today maybe a different paradigm to maybe consider and then go and explore on your own. See, I prefer to live by a completely different ethos. So I'm going to share some of that ethos with you just to give you a flavor of other ways of seeing the world. Obviously, rule number 1 is only invest in what you understand, and that includes blind faith of following the guidance of well-intentioned advisors. And I guess the extension of this is be as investment agnostic as possible. There's no question that when you're born, the situation that you were born into, your parents' view and your family's view of wealth and money is totally going to color what you think constitutes a good and bad investment. And this idea of being agnostic is partly about trying to suspend those beliefs, and it's not easy, and actually start to evaluate investments based on the merits that you have. And, part of that journey is about building your investing rules and do's and don'ts and that capacity to distinguish between good and bad. But being investment agnostic is an awesome value to aspire to. I guess the next piece is don't confuse something that's unfamiliar with risk. They're two totally different things. And let me explain. I am totally cool with someone saying, look, I don't know much about alternative investing, but I do find it very curious that I meet people all the time who say, I don't actually know anything about it, but then categorically declare it to be risky. I guess in some parts, what I want to do in this podcast is actually unpack why I think that alternative investing is neither weird and the way that I do it is not risky either. And when I say not risky, obviously all investment has risk, but not in the way that it's obviously often tarnished by wealth professionals. So the next thing is you need to understand market fundamentals. So alternative investing, for example, is definitely, up until I would say very recently, the playground of the ultra wealthy and those who really do sit outside of mainstream investing. And part of the reason it continues to be a place where only high net worth individuals play is it's an unregulated space, meaning because the governments can't really wrap their heads around it. The banks can't quite wrap their heads around it. It's almost like this very entrepreneurial space that's been created. And so people who play in this space will often only want to play with other people who are also wholesale and sophisticated investors, which means that, even though these strategies could help everyone, from young people through to mum and dad investors, generally speaking, there's a bit of an invisible gate, if you like, which stops people entering it. Because if you're in that space, you want to deal with people who are going in eyes wide open, who are educated. So that's the first piece. I think the other part of the understanding of market fundamentals is that alternative investing is by nature a very inefficient market, meaning there are more good deals out there than we see in mainstream. And that's always going to provide an opportunity for bigger returns. An efficient market, such as the share market, to a lesser degree, our traditional property strategies where you just go out and you buy houses, it's harder to find exceptional deals because that's what everybody knows. And so that is where competition is fierce, and you're obviously either having to leverage somebody else's network to get those sorts of deals ahead of others, or you've got to go out and just fight for them. So that's kind of the whole idea around, you need to understand your market fundamentals. And that's why alternative investing, for me, it's just a natural extension that because it's inefficient, I'm going to get a bigger reward. The next thing I want to make sure you understand is that you need to understand this concept, which is not spoken about, which I call downside protection. Downside protection is really about how has the risk on this investment been structured and managed. And this is just a whole, I know people who are so in the weeds and expert on these topics that they could probably speak for a week on it. The point of what I'm trying to say is when we go into an investment, we're not necessarily asking what is the downside protection. Looking at how deals are structured, what is, exit plan A, B, C, and D. And if you think about it, let me contrast a couple of examples here because I want to make this really real for you. Let's say you decide you want to go and buy a traditional house to hold as an investment property. We're talking, they're obviously expensive to buy. And let's say we went for a blue chip house or unit in a big city because we wanted to be where the action's at. We wanted to stack the odds in our favor and give ourselves the highest probability of growth. There's obviously high entry costs. There's high exit costs. Maybe you use some kind of buyer's agent or agent to help you secure it because you don't have time. Maybe you go to the banks and you use a bit of leverage. Maybe the cash flow is pretty dismal or pretty ordinary. But your hope is that over time that the market will rise, that maybe rents will go up and eventually it'll spit out a bit of cash flow. Maybe you're hoping that you'll be able to pay down the debt with your surplus income, but you're basically banking on a rising market. And, there's a good chance that you will actually do okay and it will be awesome for building your personal balance sheet. Not always, but, there's a good chance that, you look at that and on judgment and balancing out the risk, you go, yep, I like it. So that is the model that most people are familiar with, that they know, that they trust. Now let's talk about an alternative strategy. Now, obviously, there are 5 buckets of strategies that sit in alternative, but let's pick something very simple that you can probably understand because you'll have heard of it, which is a syndication, where effectively you get a group of investors and they work with a deal maker to go and buy a single asset. Now, let's assume that the syndicator is going out and buying a group of established townhouses. Number one, there's no construction risk. There are multiple exits on this deal. It's a very experienced deal sponsor. They have institutional grade due diligence that they do. They have allowed their books to remain open and auditable by an independent body. They're focused on affordable housing. So there's a large pool not only of prospective tenants, but prospective buyers. You as the investor have no involvement in the day-to-day. Somebody else is running the deal. The deal is already cash flowing on day one, meaning even if nothing happened, there is a good cushion in terms of cash flow. You're going to purchase at below market value because this has been brought to you as an off-market opportunity, and your deal sponsor has laid out in great detail a project plan to make minor improvements to the building and the units that will massively amplify the value in today's money. So they are not worried about whether the market rises. They can already see in today's money that these minor changes are actually going to inflate that valuation. So if I contrast those two opportunities, it's really obvious to me that if I'm in that stage of my investment journey where I need to build capital, then clearly something like a buy and hold strategy is great. Is there more risk in that versus something that's, cash flowing from day one? I think it's hard to say on a superficial level, but I would actually argue that what I like, and the point that I want to make about these two deals, is what I like about the townhouse syndicated deal is there are multiple exit strategies. If the market goes up, down, or sideways, we've got cash flow. Plan A might be that we're going to very gradually renovate the townhouses, increase the value of the property, and then on-sell it. Another might be that we're going to take the units and partially renovate in order to get a small increase in valuation so that we've just got that equity cushion. There are other permutations in terms of how that deal could be exited in a way that gives the investor a high degree of confidence that their capital is going to be preserved and is secured by real property. But what I love most about this is that, apart from the multiple exits, and, I probably only covered a couple here, but I like that I don't have to do anything. For me, to some degree, property, the way that we know and experience it, is a relatively active strategy. You've got to deal with tenants and toilets and maintenance. You've got to deal with securing the asset. You've got to deal with the bank. So there's a lot more friction in that deal than there is on the syndication. If I were going to summarize the key takeaways I want you to have from this particular podcast, is that people fear what they don't understand. So in answer to the original question, are alternative investments weird and risky? Are risk and return correlated? Are they that married couple? Well, in my world, the answer is categorically no, they're not married at all. I know that I can do things with my money where my return is significantly higher than I can get elsewhere for, what I perceive to be lower risk. And, as I said already, your decision to go one way or the other depends on where you are and where your interests lie. But from a wealth professional perspective, if you're someone who's seeking advice from a wealth professional, if you're asking them for advice on what you should do with your money, you need to bear in mind the filters that they bring to the table. They might say, it depends. But the filter that you should have is that, how do they get paid? How much do you know and understand? And forgetting leverage and strategy, let me just finish with this. If you handed me $1 million and said, look, you can do one of two things. You can split that into, say, 15 opportunities that would all pay you a net return of 12%, that didn't require a rising market, that could withstand economic turbulence. Or you could take that $1 million and maybe buy a nice house or a nice unit, maybe even two, that would cost me money to hold it, meaning I'd have to divert precious income into supporting that asset, but might one day go up in value. I know what I would do. The question you need to ask yourself is, do you? Till next time, guys, I hope this has been really useful. Take care. You've been listening to the Alternative Investing Podcast. If you're feeling frustrated that despite doing everything right in the property investing playbook and you're no closer to financial freedom, then head on over to incosiwealth.com to learn more about how you can use alternative investments to catapult your investing income and blend strategies to shave decades off your timeline to financial freedom. See you on the next episode.